I'm here today to discuss a very hot topic, data aggregation. The explosive rise of fintech apps during the pandemic has ushered in a new phase in the financial sector, and it's called open finance. Consumers are sharing their financial data with these new services in order to make payments, receive loans, file taxes, budget, and much more. But unfortunately, consumer financial data has historically been shared through risky data aggregation practices that can result in serious privacy, transparency, and security consequences for consumers. So I'm joined today by two gentlemen who are deeply invested in this topic. First, we have Stuart Rubenstein, CEO of Akoya, a startup whose mission is to transform the way consumers share their data by providing them with increased security, privacy, and control over their information. Stuart has spent over 20 years in the financial services industry as a digital leader, most recently heading up Fidelity's consumer API initiative prior to Akoya. He has spoken on the evolution of consumer data access to safer API-based methods, and has provided testimony before the U.S. House Financial Services Committee and the U.S. Senate Banking Committee. And then joining Stuart is Jeremy Grant, Managing Director of Technology Business Strategy at Venable. Jeremy has more than 20 years experience at the intersection of identity, privacy, and cybersecurity, having served in a range of leadership positions spanning government and industry. He led the National Strategy for Trusted Identities in Cyberspace, housed in the National Institute of Standards and Technology, or NIST, and served as NIST's Senior Executive Advisor for Identity Management. Jeremy also serves as the coordinator of the Better Identity Coalition, an organization focused on developing and advancing consensus-driven cross-sector policy solutions that promote better solutions for identity verification authentication. Thank you both so much for being with us today. Let's go ahead and get started here. With my first question, I wanted to talk a little bit about, why is identity a critical issue in data aggregation today? Jeremy, do you want to start us out with that?
Sure. Well, I think it's pretty straightforward. Pretty much every use case in terms of data sharing involves making sure that every party knows who's making the request, or at least that they're authorized to do so. And every criminal who's trying to crack through these systems, depending on being able to cut through the weak identity controls in place to steal data and money. So, I often point out we'll be this July 28 years from the famous New Yorker cartoon that Pete Steiner came up with, where the dog's on the computer and says to his friend the dog on the internet, "Nobody knows you're a dog." Those dogs are 28 years old now, which means they're long gone, unfortunately, because of dog years, and their kids may be too. But the problem's with this more than ever. And I think, as we're seeing the challenges with dogs on the internet, certainly data aggregation has been one of those places that challenge is still proving to be quite difficult to solve.
And Stuart, what about you? What's your take here? Why is identity a critical issue in data aggregation?
Yeah, that's exactly right. And thanks for having us today, Olga. And I'm glad to be here with Jeremy. It's really proving, to the financial institution that holds data, who you are, right? The majority of consumer financial data aggregation today is still done through a process called screen scraping. And the way screen scraping has worked in the past is that consumers have been giving their IDs and passwords, right, their credentials, to a third party, to a fintech, maybe to a fintech then gives it to a data aggregator. But the financial institution doesn't really know if the consumer handed over those credentials, or those credentials might have been obtained through a hack of some sort. All they know is they're seeing valid credentials show up. And listen, most of the time that is the consumer, right? It is someone who wants to use a third party service. But unfortunately, the way simple IDs and passwords have worked, right? We can't trust that anymore. We need to get to a better place. We need to get to a place where consumer credentials are taken out of the system, that someone's not just acting on behalf because they have those, right? That third parties aren't storing them, right? That's a problem. And that consumers really understand that when they're working with third parties, that their counterparty, the financial institution, knows who they are, and that both sides understand what is being transferred, what is being transferred. So it starts with identity, but it goes, I often call that authentication, right? Because we use it for authentication, but then it goes down to authorization as well.
Got it. So then, how should institutions overcome these challenges with the screen scraping? Jeremy, do you want to take that first again?
Yeah, well, I think the short answer is, move to APIs. I mean, the idea that we're using passwords and shared passwords as the basis of enabling so many different applications in fintech, as a security guy, I've always found a little bit terrifying in that, passwords are more or less useless for security these days. I mean, the idea that there's somehow a strong password, if it's 12 characters with your uppercase and lowercase and symbols and numbers, that's not where attacks happen these days. Nobody's brute forcing your password. The attacks are coming in through password reuse, where if your password shows up in a breach in one place, odds are good you're using it in another place. And you're seeing, with that, a lot of credential stuffing attacks where criminals have basically just have bots that can, try to, blitz the login sites of different, online service providers and banks and retailers and others to hope you get a hit. Or phishing attacks where you can trick people to handing over their password, or even in many cases, the one-time passcode that they might use as a second factor. So there's just no security there anymore. And the idea that you're going to build secure financial apps based on a premise that somebody's going to be sharing your password that already doesn't have much security with a third party, and then they're essentially going to log in as you, it's just a foundation for lots of bad things to happen. The good news is, with APIs that are being developed, there's a much more secure way to do stuff. And, certainly I think the APIs paired with multi-factor authentication, can really go a long way to addressing some of these security concerns and providing a very, great foundation for data sharing that's not only more secure, but also a lot easier to use in terms of who likes typing their password in, particularly on a mobile device. You fat finger it, you think you get it wrong. There's also been an issue as a lot of financial institutions are trying to push out multi-factor authentication to their customers. Well, if they're hooked into a fintech app that's reliant on password-based screen scraping, well, MFA basically breaks that. So you need to go to an API that can actually support MFA as well for best security. So, I've been really impressed with the work that groups like Financial Data Exchange, FDX have done. Their control considerations specifically point to how you can use modern authentication protocols like the FIDO standards, like OpenID Connect, alongside the API, so that a bank can really offer best-in-class security and a better user experience while still making it easy for consumers to then authorize, fintechs and other third parties to be able to tap into their account data.
Mm-hmm. Thanks, Jeremy. Stuart, what about you? What do you think should be the approach there? How should institutions overcome these challenges with screen scraping?
Yeah, I think, as Jeremy's point is, it's move to the API, or move to an API. Standards help because then everybody can connect the same way. And that's why we're big supporters of Financial Data Exchange and the work that's being done there. But I'll take it, let me take it from a different tactic. Let's take it from the consumer and a financial institution and the fintech lens, if you will, right? The consumer wants to get their data into an app, for budgeting, for tax planning, right? For payments, peer-to-peer payments, right? All sorts of reasons. What you want to make sure in that process is the consumer is actually instructing their financial institution that it's okay for this app to get access to their data, right? It's not, let's share this, right? It's no, this app needs access for this purpose. And I, the consumer, want that to happen. That's what the standards in FDX are going to allow. That's what OAuth is doing, right? When you do that and you have the consumer permission with the institution, that allows the institution to put on whatever kind of authentication method they want, because it's happening directly, right? When it happens indirectly through screen scraping and a passing of a password, things break, right? Those authentication methods, as Jeremy mentioned, right? Like, screen scraping breaks because there's no authentication in the process. But when we can do that and have that direct instruction given, it not only makes everyone comfortable that it is the consumer, right? Going back to the identity question, but it also allows the FI, who's really responsible for keeping that data safe and keeping that account safe, it gives that financial institution the ability to help the consumer, help them not only authorize this fintech app, right, or another one, but help the consumer monitor on an ongoing basis who has access to their data, and then allows them to revoke that consent at any time. So the faster we move over to a standards-based API approach, the faster we can convert away from the riskier ways of doing things today. We can get things like credential stuffing attacks kind of removed from this whole sector, and move on to a safe, just a safer, more secure way of doing it. I mean, just recent events, that we've seen, whether it's the SolarWinds attack or whether it's the Colonial Pipeline, right? It shows that there's too much risk in systems when people are handing out their passwords to others, right? Through whether it's deliberately, whether it's through phishing or other means. There's too much risk in system-to-system connections that we're not 100% sure are being authorized by the individual. So let's do everything we can to step it up and to really increase our authentication, and then allow data to flow, because we need it to flow for innovation.
Thanks, Stuart. So, I mean, it certainly seems like APIs are a great option. So, and Jeremy, why haven't APIs taken off as an alternative to screen scraping?
Well, I think there's a few reasons. One, it's hard, or it has been hard for some organizations to stand them up. And so I think there's some technical work that, still needs to be done to make things easier. In fact, that's a lot of what Stuart's working on at Acquire right now, is how do you come up with an easy button as opposed to having to do custom work. I think there's also been an issue where, and there's really some division, I think, across the fintech community, but there's at least some firms that have been reluctant to embrace APIs, and that they like all the data they get from screen scraping. To give you an example, I mean, I've got my primary bank account, has my checking account, my savings account, my mortgage, and a home equity line of credit all tied to it with a single logon. I might be interested in letting, a fintech app have access to that checking account in my balance, but the other stuff I want to be able to keep, only to myself. With screen scraping, it's been all or nothing. And so I think there's a model where at least some firms are enjoying having all that data. And, if it goes to something that's much more granularly permissioned, where I as a consumer can, say that I want to have something different, well, that may shift the business model around. I think there's also been issues where, look, a lot of what we've seen with APIs, some of the bigger banks have implemented them, and they've done, sort of a lot of, I would call, single bank to fintech negotiations, but it, takes time, a lot of lawyers and business negotiations. There's been challenges, I think, for the next level down of banks, the small and mid-sized banks, your credit unions, whatnot, et cetera, where they're just not, getting back to the issue of it's hard. They're not quite sure how to go about implementing an API. They're not big enough to be doing these deals, with some of the different fintech platforms. And so getting to that next level down has been harder. We're making good progress every year. And in fact, I'd love to hear what Stuart has to say in terms of his thoughts on how to get to that next layer.
Yeah, thanks, Jeremy. We have seen progress, right? So it's not that they haven't taken off. I think the better thing is that the better way to say it is that they are taking off. And the question is really, how do we accelerate that adoption? Right? Because a number of large financial institutions, as you said, have entered into API-based data access agreements and continue to do them. But the numbers are really small. And the reason they're small is because each one of those is a bilateral negotiation. It's a large institution negotiating with a data aggregator or a very large fintech on a one-off basis. And then it starts all over again. Whether if you're the aggregator, you now have to go talk to the next bank. If you're the bank, you go talk to the next aggregator. That does not scale to the thousands of institutions that we have in the US marketplace. Right? There's just not enough capacity on either side to have all those discussions. It's why we started Akoya, actually. We started it because it's really a network problem. So we bring a network solution and negotiate once on each side instead of all of those to get those up and running. The good news is we've made lots of progress on the technical standards, right? FDX, again, Financial Data Exchange, has done a great job, and we've been happy to participate in that, has done a great job of setting the the technical standards, it's now getting more firms to adopt that. Again, I do believe a network approach is the way to do it.
Thanks, Stuart. And Jeremy, I wanted to dig into something a little, more specific here. How do you anticipate the U.S. government playing a role in addressing some of these challenges?
I think there's a few different places. Look, the most obvious one, the one that's gotten tons of attention the last 6 months, has been that the CFPB proposed, I think it was last October or so, an advance notice of proposed rulemaking specifically on this topic, where they said, look, we're thinking about regulating here. They laid out a bunch of different questions they had that they were trying to get input on. And, I think the assumption there is they'll come back with a proposed regulation at some point. Where I was encouraged by that initial publication, that request for comment, is it talked a lot about APIs. It talked about the problems with passwords. It talked about, balancing security with user experience. And so I think they're asking all the right questions. Now their challenge is going to be, how do you actually come up with regulations that can, perhaps push people toward API adoption more quickly. But we've seen other parts of government as well that certainly have a role. FinCEN, the Treasury's Financial Crimes Enforcement Network, their director Ken Blanco back in 2019 gave a speech talking about the fraud that they were seeing with fintech platforms and people taking advantage of some of the kind of just so-so identity controls that were there to commit financial crimes. We also are seeing the FFIEC, the Federal Financial Industry Examiners Council, which is essentially all the big regulators coming together. About a year ago, they had a workshop looking at whether they should update the regulations for consumer authentication for online banking, where right now I think there's some advancements in MFA that weren't there when they last updated these 10 years ago. And, there was at least talk about would they potentially mandate stronger types of MFA, which if that were the case, banks couldn't just let you access your accounts with a password anymore. So I think between all of those different elements that are out there, there's a lot of different places where the government might be on the regulatory side pushing buttons. On the Hill, they've been monitoring this. They ask questions about it a lot. I don't know that you're going to see legislation pushing stuff, but I think there's a lot of interest in seeing the CFPB do a good job on whatever regulations they put out in the next year.
Excellent. Thank you so much, Jeremy. For this next question, I'd like to start out with Stuart. I'm imagining that a lot of people in our audience are thinking, well, how do I even go about doing this, right? So, what would your advice be for a financial institution, who's just starting their open finance roadmap today? What do they need to do?
Yeah, I think the hard part really begins, when you start the process of connecting with all the various data aggregators and fintechs, right? The first thing is look at your logs and see who's coming to your system now, right? To understand, and it may be your system or maybe a front end that's hosted by someone else, but you need to get into those logs and see, what are the services that your clients are using, so you know where to start, who to talk to, who to work with. But the idea is basically you have to move away quickly from accepting IDs and passwords from those who they haven't been issued to. You just don't know, right, that those were actually authorized or not, right? Many times your client does do that, but with credential stuffing being one of the #1 attacks on financial institutions these days, and credentials being reused and stolen credentials being so available on the web, there is a lot of risk there. So it's work with them, whether it's your core provider, whether it's your clearing firm, if you're in the brokerage business, or if you run your systems yourselves, right? It's your own technology team needs to start to think about how do we move this to an API? We want to service our customers. We have to get everybody on APIs, I think, and get out of the credential business. You make sure that customers are selecting what data they want to share. To Jeremy's previous example, selecting only the specific accounts and not his whole list of accounts, but only a checking account in that case. All of that gets accomplished through moving to the API. Get involved with FDX, learn what the standards are. There's a lot of information on the Financial Data Exchange website. Definitely get involved with FDX. You can certainly, talk to those who are in the business of helping to facilitate that data movement, to, integrate once instead of having to do it all yourselves, or you can build teams to do it all yourselves. Lots of different ways to do it, but, start to wrap your head around, how do we move off of third parties scraping data from our site using credentials, very high risk move. They have access to all transactions, to a way that's more secure, more transparent to the consumer, and is actually controlled by the consumer, right? The consumer grants access, monitors access, revokes access. I think starting to put your lens on that and prioritizing it is critical. Until we do that, I do believe institutions are at risk. I do believe that accounts are at risk. That's my belief. Lael Brainerd from the Fed has spoken on it a few times. She believes they're at risk. Treasury's issued a report a few years ago. We have to, no one's prescribed exactly how to move. We believe that that moving to an API like the FDX API is the way to do it.
Thanks, Stuart. And Jeremy, anything that you want to add there? What would your advice be for a financial institution that's just starting out on this open finance roadmap?
I like what Stuart had to say, and I'll point out that the good news is with things like FDX, which has been jointly crafted by banks and fintechs coming together, a lot of the hard work's been done. So if you were doing this 3 or 4 years ago, I think you would have been in a different place than you are now. The tools are out there. I think one piece of advice I give with it, getting back to the point I made before about multi-factor authentication, is as you're looking at this, also consider where you're going with your authentication roadmap. And I'll go a little bit out on a limb and say, I think it's likely based on the signals that we're seeing from government. And we just saw an executive order signed by the Biden administration that's mandating MFA everywhere in government, and for any government suppliers building software. I think it's likely in the next couple of years, banks are going to be required to implement MFA as opposed to it just being sort of strongly encouraged right now, or they'll get more specific in terms of what it's going to look like. And so I think, there it's really nice that FDX, again, their control considerations, points to how the API integrates with, authentication standards like FIDO and OpenID Connect. And so looking at this all as, one big, customer journey, or not customer journey, how do you improve the customer journey so that they can have both passwordless authentication that's multi-factor, and the way with that to tap into something like the FDX API to then granularly authorize what third parties can and can't do. I think it makes a lot of sense to put those two initiatives together.
Thanks, Jeremy. And we just have a couple of minutes here left. So to wrap things up, Stuart, what's next for US open finance ecosystem?
Yeah, ultimately, our goal at Akoya is to enable a future where open finance really takes off in a secure and universal way. The only way to do that, though, is to de-risk the data access ecosystem by moving away from screen scraping, empowering consumers to grant access to their financial data, just by making it safer. The safer we make it, not only the better it will be, but the safer we make it, the more people will adopt it, which will increase those investing in innovation, which will continue to improve financial lives.
Thanks, Stuart. And Jeremy, to wrap things up, what's your take? What's next for the US open finance ecosystem?
I think it's a lot of what Stuart said. I think now that we sort of know how to do this technically, I think you're going to see more rapid adoption of the shift to APIs. The one thing I will keep an eye, and I am based in Washington, D.C., is, what do the CFPB regs call for? They're one of the pieces of advice we offered when we commented in the Better Identity Coalition was, regulations can be helpful, but make sure you're not too prescriptive. I look at the experience we've had in Europe with PSD2, Payment Services Directive 2, where it's interesting. For a few years ago, I think they thought that they were going to be getting ahead on open banking, but their regulations were so prescriptive in terms of explaining, very specifically how things may and may not work, that it's actually moved a little bit slower there. Because if you overregulate, then people just get confused and they're not quite sure what to do. So I think, coming up with something that builds on the great progress that's being made in the market, with APIs like FDX, with firms like Akoya, coming up with ways to just enable things, I think we can get there a little quicker than other countries, leveraging a mix of regulatory and market drivers.
Excellent. Thank you so much. And with that, we'll go ahead and wrap things up. Thank you again to Stuart Rubenstein from Akoya and Jeremy Grant from Venable.